Two people, same salary, same years of contributions. Two very different account balances on screen. The instinctive read is that the bigger number is winning. That instinct is one of the most common and most understandable mistakes in the entire traditional versus Roth conversation, because one of these balances is carrying a debt that never shows up on the statement. Taxes it hasn't paid yet. Today, we are going to do the real math on traditional 401k versus Roth IRA, including the invisible liability that most comparisons never put on the page. Traditional and Roth accounts are not competing investment products. They are the exact same investment wrapped in two different tax arrangements, and the entire decision comes down to a single underlying question. Is your tax rate today higher or lower than the tax rate you expect in retirement? Everything else in this comparison is a modifier on that one core bet. I went through the research on marginal tax rates in retirement, required minimum distribution rules, and the real after-tax outcomes of traditional versus Roth contributions for this one. What I found is a small number of factors that actually decide which structure wins for a specific person, and a very common comparison mistake that makes one balance look artificially ahead of the other. Let's build it. A traditional 401k contribution is made with pre-tax income, grows tax-deferred, and is taxed as ordinary income when it's withdrawn in retirement. A Roth IRA contribution is made with income that has already been taxed, grows tax-free, and comes out completely tax-free in retirement. Assuming identical investment growth, the entire difference between these two structures comes down to one variable: whether your tax rate is higher now while contributing or higher later while withdrawing. This is the single most important fact in the entire comparison, and it's the one most casual conversations skip entirely. If your marginal tax rate is exactly the same at contribution and at withdrawal, traditional and Roth produce a mathematically identical after-tax result. The entire decision only tilts one way or the other because of a genuine difference between your tax rate today and your expected tax rate in retirement. And everything in Section 2 is really about estimating that difference as accurately as possible. There are 6 factors that determine which account structure actually wins for a specific person in a specific situation. None of them produce a single universal answer. All of them are things you can reasonably estimate about your own circumstances, which is far more useful than a blanket rule repeated without context. Factor 1, your current tax bracket versus your expected retirement bracket. If your marginal tax rate is meaningfully higher right now than you expect it to be in retirement, a common situation during peak earning years before Social Security and reduced retirement income lower your bracket, the traditional 401k generally comes out ahead because you take the tax deduction now when it's worth the most and pay tax later at a lower rate. The reverse applies for someone early in their career, currently in a lower tax bracket than they realistically expect to occupy later, whether from career growth, a paid-off mortgage no longer providing a deduction, or simply a well-funded retirement generating more taxable income than expected. In that case, paying tax now at the lower rate and enjoying tax-free withdrawals later at the higher rate generally favors the Roth structure. Factor 2. The employer match only exists in the 401k. An employer match on a 401k is an immediate, guaranteed return that has nothing to do with the traditional versus Roth comparison at all. It exists only inside employer-sponsored plans, not IRAs. If an employer offers a matching contribution, capturing the full match by contributing at least enough to the 401k to receive it is almost always the correct first move, regardless of which structure ultimately wins the rest of the comparison, because the match itself is not available anywhere else. Many employer 401k plans now also offer a Roth 401k option, which can capture the same match while still using Roth tax treatment on the employee's own contributions. Worth checking before assuming the choice is strictly between an employer 401k and an outside Roth IRA. Factor 3. Required minimum distributions. Traditional 401k and traditional IRA accounts are subject to required minimum distributions beginning at a specific age, forcing withdrawals, and the accompanying tax bill, whether or not the money is actually needed that year. Roth IRAs are not subject to this requirement during the original account holder's lifetime, which allows the money to keep growing tax-free for as long as it's left alone and gives the account owner far more control over exactly when income is realized. This factor carries the most weight for people who expect to have other sources of retirement income and don't necessarily need to draw down this specific account on any particular timeline. For them, the forced distribution schedule of a traditional account can create tax complications a Roth IRA simply avoids. Factor 4. Tax diversification reduces retirement year risk. Holding both traditional and Roth balances in retirement provides genuine flexibility that neither account alone can offer. The ability to pull taxable traditional withdrawals up to the edge of a specific tax bracket in a given year, then switch to tax-free Roth withdrawals for any additional spending needed that year, without pushing into a higher bracket. This kind of tax diversification is difficult to replicate with only one account type, and it's a meaningful, often overlooked argument for holding some balance in both rather than betting the entire retirement on a single tax structure being the right call decades in advance. This is the one factor in the entire comparison that doesn't actually argue for picking a side. It argues for hedging the underlying uncertainty about future tax rates by holding a meaningful balance in each structure, giving your future self more control over the situation than a single irreversible bet made today. Factor 5. State tax arbitrage. For someone currently working in a state with meaningful income tax who plans to retire in a state with little or no income tax, a traditional account can capture a real additional benefit. The tax deduction happens now at the higher combined federal and state rate, while the eventual withdrawal is taxed later, potentially at a lower combined rate if the state tax portion has been reduced or eliminated by the move. A Roth contribution locks in today's combined tax rate, regardless of where you eventually retire. This factor should be weighted according to how realistic the future relocation actually is, not as a given. It is a real and sometimes underestimated addition to the traditional side of the comparison for people with a genuine, concrete plan to relocate, and largely irrelevant for people who expect to stay in the same state throughout retirement. Factor 6. Roth contribution accessibility. Roth IRA contributions, though generally not the investment earnings on top of them, can typically be withdrawn at any time and any age without taxes or penalties since the contribution was already taxed going in. Traditional 401k withdrawals before retirement age generally trigger both ordinary income tax and an early withdrawal penalty on the entire amount. This gives a Roth IRA a genuine flexibility advantage as a partial emergency backstop that a traditional account structurally cannot match, though it works best as a last resort feature rather than a reason to treat retirement contributions as a general-purpose savings account. This factor matters most as a risk reduction feature for someone without a fully built emergency fund yet, rather than as the central reason for the account choice. The core decision should still rest primarily on the tax rate comparison from Factor 1. Here is the mistake at the center of almost every casual traditional versus Roth comparison. Looking at two account balances side by side and assuming the larger number is winning. A traditional account balance has not yet been taxed, while a Roth balance already has been. Comparing the two raw numbers directly is comparing a pre-tax figure against an after-tax figure, which is not a fair comparison at all. The traditional balance needs to have its embedded future tax liability subtracted before it can be honestly compared to the already tax-free Roth balance. Once that adjustment is made, the two coworkers from the cold open often turn out to be far closer in actual spendable retirement wealth than their raw account balances suggested. And in some cases, the coworker with the smaller-looking Roth balance is actually ahead once the invisible tax liability sitting inside the bigger traditional number is properly accounted for. Run the math for someone currently in a meaningfully higher tax bracket than they expect in retirement, and after adjusting the traditional balance for its future tax bill, traditional comes out ahead in spendable after-tax dollars. Run the identical math for someone whose bracket is expected to stay the same throughout, and the two options land at essentially the same after-tax outcome, exactly as the core mechanism from Section 1 predicts. Run it a third time for someone early in their career, currently in a lower bracket than they realistically expect later, and Roth comes out ahead by a comparable margin in the opposite direction. This is the clearest possible demonstration that traditional and Roth are not competing on investment quality, fees, or growth potential. Those are identical in every scenario. They compete entirely on a single estimate: which side of the current versus future tax bracket comparison you actually land on, which is exactly why running your own honest numbers matters more here than following a general rule borrowed from someone in a different tax situation. Here is how to actually apply this to your own retirement contributions, rather than defaulting to whichever account type a friend or headline happened to recommend. Before comparing anything else, confirm you're contributing enough to your 401k to receive the complete employer match if one is offered. This step is correct regardless of which structure wins the rest of the comparison, because the match itself doesn't exist outside the employer plan. This is the single most important question in the entire decision. Estimate your current marginal bracket honestly and make a realistic, not optimistic estimate of your retirement income and corresponding bracket. This comparison should drive the majority of your decision. If you expect other income sources to cover most of your retirement spending and would prefer to control exactly when this specific account gets taxed, the absence of required minimum distributions on a Roth IRA becomes a meaningful point in its favor. If you genuinely aren't sure how your tax situation will evolve over the coming decades, consider deliberately building a balance in both structures, giving future you real flexibility to manage taxable income in retirement rather than locking in a single, irreversible bet today. If not, the penalty-free contribution withdrawal feature of a Roth IRA is a legitimate, if secondary, factor worth weighing. Just don't let it become the primary reason for the choice, since the tax bracket comparison from question 2 should still be doing most of the work. Here is the reframe I want to leave you with. Traditional and Roth were never competing on which account is objectively better. They are the same underlying investment taxed at two different points in time, and the entire comparison comes down to a single honest estimate. Is your tax rate higher now, or will it be higher later? Everything else, the employer match, required distributions, state tax planning, contribution flexibility, is a real but secondary modifier on that one core bet. That does not mean the decision is arbitrary. It means it deserves an honest look at your own current and expected future tax brackets, not a rule borrowed from someone in a completely different career stage or tax situation. Run your own numbers, adjust every traditional balance for its embedded tax bill before comparing it to anything, and let that comparison, not a generic recommendation, decide.